Buying the dip sounds smart. Most people who try it lose to the people who don't even try. After years on Wall Street watching this play out hundreds of times, I'm going to show you the math and one number from a Charles Schwab study that's going to genuinely shock you. By the end of this video, you'll know exactly which approach builds wealth and which one quietly destroys it. And I'll tell you what I actually do with my own money. Okay, so here's the question I get all the time, and I mean all the time. Should I just invest steadily every month no matter what? Or should I wait for the market to drop and buy the dip? I'm going to be honest with you. I spent years on Wall Street. I watched really smart people get this completely wrong. Not because they lacked information, because they let their psychology drive their decisions instead of the math. So today, let's actually settle this. Dollar cost averaging versus buying the dip. We're going to look at real numbers, a fascinating Charles Schwab study that tracked 5 investors over 20 years. 2 real people I'll call Mark and David, and the one strategy I personally use that combines the best of both worlds. Let me break this down starting with dollar cost averaging. Most people call it DCA. The idea is dead simple. You pick a fixed dollar amount, say $500, and you invest it on the same day every month, no matter what the market is doing. Up, down, sideways, doesn't matter. You invest. Think of it this way. When prices are high, your $500 buys fewer shares. When prices are low, your $500 buys more shares. Over time, you're automatically averaging out your cost. You're not trying to be clever about timing. You're just steadily accumulating ownership in a business or an index, paycheck after paycheck. DCA actually has a real history, by the way. The concept was popularized back in 1949 by Benjamin Graham. Yes, the guy who taught Warren Buffett. Graham wrote a book called The Intelligent Investor, and in it, he laid out this exact idea. Most regular people will never time the market well, so the answer isn't to get better at timing. The answer is to remove timing from the equation entirely. 76 years later, every piece of follow-up research has confirmed he was right. Mathematicians, behavioral economists, fund managers, they all keep arriving at the same conclusion. Consistency beats cleverness, by a lot. Here's what I actually did when I first started building my personal portfolio outside of work. I opened my banking app, set up an automatic transfer into a low-cost index fund on the first of every month, and told myself I wasn't allowed to touch it. No watching the ticker, no reading the news in the morning to decide if it's a good day to invest. The transfer just runs, forever. And boring in investing is a compliment. DCA does 2 things really well. First, it removes emotion from the equation entirely. You don't have to decide anything because the decision is already made. Second, it builds discipline. And discipline, more than any hot stock tip, is what actually creates long-term wealth. Now, let's talk about buying the dip. The pitch sounds great. Wait for stock prices to fall, then swoop in and buy at a discount. It's basically the investing version of waiting for a sale before you buy something. Who doesn't want a 20% discount? Here's the catch, though. When exactly is a dip? A 5% drop? A 10% drop? What if it drops 10% and then keeps dropping another 20%? What if you wait for a dip and the market just doesn't dip? What if it goes straight up for 2 years while your cash sits in a savings account earning almost nothing? Nobody talks about this, but the core problem with buying the dip is that it requires you to predict the future. You have to know when a decline is temporary versus the start of something worse. And here's the thing, even professional fund managers with entire research teams, Bloomberg terminals, and decades of pattern recognition get this wrong constantly. Back when I was on the trading desk, I watched brilliant people confidently call the bottom of a market move and be completely wrong. 3 times in the same quarter. They'd buy what they were convinced was the bottom, the market would drop another 8%, they'd capitulate, sell, and miss the actual recovery.
That's professionals, with research budgets bigger than most people's net worth. The market trends upward over long periods of time. That's just history. So every day you're sitting in cash, waiting for the perfect entry, the market might be climbing without you. And that missed time in the market costs you real money. Not theoretical money, real money. Let me give you a concrete example so you can see what this actually looks like. Meet Mark and David. Both have $6,000 to invest over 1 year. Mark uses DCA. He sets up his banking app to auto-transfer $500 into an index fund on the first of every month. 12 contributions. He does literally nothing else for the entire year. David decides to buy the dip. He holds his $6,000 in cash and waits for a 10% correction before putting his money to work. Now, here's what happens in this fictional but very realistic year. The market has a rough first quarter, drops around 8%. David watches. He thinks it might fall more, so he stays out. Then, a strong jobs report comes out. Markets reverse hard and start trending up. Nothing hits David's magic 10% threshold. By the end of the year, David's cash has done essentially nothing. He never found his perfect moment. Mark, meanwhile, was invested through the whole ride. He bought more shares during the dip in Q1, automatically because his $500 went in regardless, and fewer shares as prices recovered. He captured the full year's average return. Now, I'm going to be real with you. Even if the market had dropped a full 10% at some point, David would have had to time both the buy and the recovery perfectly. Miss the exact bottom by a few weeks in either direction, and the advantage evaporates. In practice, almost nobody catches it perfectly. Not retail investors, not professionals. Almost nobody. Okay, now here's the part that changed everything for me. The Charles Schwab study. Schwab tracked 5 hypothetical investors over a 20-year period, from 2003 to 2022. Each investor got the same deal, $2,000 a year to put into the S&P 500. Same money, same index, same time period. The only thing that changed was the strategy. First investor, Peter Perfect. Peter had a superpower nobody actually has. He could see the future. Every single year for 20 years, he invested his $2,000 at the market's absolute lowest point. Not the lowest week, the lowest day. 20 perfect bottom calls in a row. After 20 years, more than $138,000. Second investor, Ashley Action. No superpowers, no timing. She invested her $2,000 on the first trading day of each year. Lump sum, day one, every year, no questions asked. Her result? More than $127,000. She made about $10,500 less than Peter, the guy with literally perfect, godlike timing. And she didn't have to do anything special. Sit with that for a second. The reward for nailing the exact bottom every single year for 2 decades was about $10,500 over 20 years. That's $525 a year for a superpower. The price of being clever about timing is barely the price of 1 extra dinner out per month. Third investor, Matthew Monthly. He split his $2,000 into 12 equal monthly contributions. Classic DCA. Result?
more than $124,000. Almost identical to Ashley, who invested everything up front. Fourth, Rachel rotten timing. Rachel had the worst possible luck. She always invested at the market's yearly peak, the absolute worst moment every single year. If a year had a crash, she'd somehow buy the day before. She still ended up with $121,000. Think about that. Even with the worst timing imaginable, consistently investing still beats sitting on cash. And then there's Larry Linger. Larry waited. He kept his money in cash, always looking for the right moment that never quite felt right. He read the news. He watched market commentary. He convinced himself a better entry was always just around the corner. Larry ended with $44,130. I want you to really sit with that number. Larry left more than $77,000 on the table compared to Rachel, the person with the worst timing imaginable. That $77,000 is a down payment on a house in most of America. It's 3 years of college tuition. It's a brand new car every 5 years for a decade. All gone to inaction. Not to bad timing, to inaction. Most people get this completely wrong. They think the risk in investing is buying at the wrong time. The real risk is not being in the market at all. Bad timing costs you a few thousand. Inaction costs you a house. Here's the takeaway from the Schwab study. In order of performance over 20 years. 1. Lump sum investing immediately. Put the money to work right away. 2. Dollar cost averaging. Consistent monthly contributions. 3. Imperfect timing, but still investing. 4. Terrible timing, but still investing. And dead last, by a mile, waiting in cash. The best strategy, mathematically, is to invest everything you have right now. But I know most people aren't getting a lump sum dropped in their lap. Most of us earn a paycheck and invest from income. That's exactly where DCA shines and why it ranked right behind lump sum investing. Because lump sum investing is just DCA with a very large first contribution. Now, before someone asks, does this mean you should never buy the dip? Are there situations where waiting actually makes sense? Yes, there are exactly 3. 1. You just got a windfall. Inheritance, sale of a business, a large bonus, the cash is already there. In that specific case, lump sum statistically wins, but the emotional risk of investing $50,000 on Tuesday and watching it drop 15% on Wednesday is real. So if you can't stomach lump sum, splitting it over 6 to 12 months, basically a fast DCA, is a reasonable compromise. 2. You have an opportunistic reserve. This is what I personally do, and I'll get back to it in a minute. 3. There's a genuine, identifiable, once-in-a-decade event. 2008, March 2020. Periods where the entire market has dropped 30 to 50% in a panic and there's blood in the streets. Even then, you're not predicting the exact bottom. You're recognizing extreme conditions. There's a difference. Notice what's not on this list. I think the market is overvalued is not on the list. Things feel uncertain is not on the list. I read an article that said a correction is coming is definitely not on the list. Those are not buy the dip triggers. Those are excuses to never invest. Now let me tell you what I actually do with my own money. I think you'll find it pretty close to common sense once you hear it. My core strategy is DCA. My automatic contributions go in every month no matter what. Paycheck day, transfer hits, Money is invested before I ever see it in checking. That's the engine. But I also keep a small cash reserve, somewhere around 3 to 5% of my investable assets, specifically to deploy during sharp market drops, major panics, the kind of moment where the market is down 25% and the news headlines are nothing but doom. The key is what I'm not doing. I'm not waiting. I'm still fully invested through my regular contributions. The extra cash is just an opportunistic layer on top. I'm not holding $50,000 out of the market hoping for a crash that might not come for 3 years. If you watched my last video on dividend versus growth stocks, you'll remember the 3-level framework based on your age and timeline. DCA is the engine that powers all 3 levels. Whether you're 25 and going heavy on growth, 45 and balancing both, or 65 and mostly in dividends, DCA is what keeps your money flowing into the right buckets, automatically, without requiring you to time anything. The framework is the steering wheel. DCA is what makes the car move. Now let's talk psychology, because this is where most people lose the war they thought they were winning. It's easy to say you'll buy the dip when the market is calm. The plan looks great in a spreadsheet, but when the drop actually comes, when your portfolio is down 20% and the news is terrifying and everyone around you is panicking, most people don't buy. They freeze. Or worse, they sell. I've seen it happen, up close, again and again. Back when I was on the desk, I'd watch retail investors, the same people who'd told me a month earlier they were ready to buy any 10% dip, completely freeze when the dip arrived. Their hands didn't move. Some of them even sold near the bottom because they couldn't take the pain. The math is clear in a spreadsheet, but human brains aren't spreadsheets. This is exactly why Warren Buffett, who, by the way, is one of the greatest market timers who ever lived, has said over and over that for most regular people, not professional investors, not hedge fund managers, the smartest move is consistent investing in a low-cost index fund.
Not because it's the theoretically perfect strategy,
Because it's the one people can actually stick to. A strategy that works on paper but you can't execute under stress is worthless. A strategy that's slightly suboptimal on paper, but you can run for 30 years on autopilot, that's the one that actually makes you rich. Here's what I want you to take away from all of this. If you're waiting for the perfect moment to start investing, you're already behind. The Schwab data is unambiguous. Even the worst possible timing beats sitting in cash. Every month you wait is a month your money isn't compounding. Every month you wait is a month closer to becoming Larry. If you're already running DCA, you're doing it right. Stay consistent. Don't let market volatility derail your schedule. Those months when everything feels scary are often the months you're getting the best prices. Don't even check your portfolio during those windows if it's going to make you nervous. The transfers run themselves. And if you want to keep a small cash position to deploy during big drops, fine, but keep it small. Define what counts as a big drop in advance, and don't let it become an excuse to not invest the rest. 3 to 5%. That's it. Anything more, and you're just back to being Larry with extra steps. I have a free early retirement calculator linked in the description if you want to plug in your own numbers and see what consistent investing actually does to your timeline over 10, 20, 30 years. The results are usually more motivating than any lecture I could give you. Plug in your real income, your real savings rate, and a realistic average return, and watch what compounding does. Link in the description. The single best investing decision most people can make is to start, stay consistent, and not overthink it. The market rewards patience and consistency far more than it rewards cleverness. I'd rather be a Matthew Monthly than a Larry Linger, every time. So tell me in the comments, Are you a Matthew Monthly running steady DCA? A Larry Linger still waiting for the right moment? Or something in between? And if you're waiting, what's your trigger? What does the right moment actually look like to you? I'm genuinely curious. I read every comment and I'll answer the ones that ask the best questions. If this was useful, hit subscribe. Next time, we're going to break down what an emergency fund actually needs to be in 2025 and why the standard advice on this is wrong. See you there.